Welcome back, everyone. Next, we have Strawberry Fields REIT, Inc. It trades on the New York Stock Exchange under the symbol STRW. It's a self-administered real estate investment trust engaged in the ownership, acquisition, development, and leasing of skilled nursing and certain other healthcare-related properties. Happy to welcome Chairman and CEO Moishe Gubin. Nice to see you, Moishe.
Good to see you again, Anna.
All right, give us an update of what's going on with Strawberry Fields, and we'll take questions from our viewers at the end.
Oh, beautiful. Okay, so we're nearing our 1-year anniversary being on the New York Stock Exchange. Really proud of that. To understand our company, you really got to understand our history. And really, this story begins with two guys that had the same friends in high school, but never knew each other. And we met in the Midwest. And this was 20 years ago. My partner, Michael Blisco, and I, we bought our first nursing home October 31st, 2003. Throughout the years, we've accumulated a lot of buildings, and we spun off Strawberry Fields REIT in 2015 with 33 facilities, basically in Indiana and Illinois. Our goal at the time was to kind of diversify operators and diversify locations. Like I said, I'm the founder, CEO, and chairman of the company. I've been here since day one. Very different than a lot of the other REITs out there. A lot of the other REITs out there are started by investment banks and people with an idea, raising money, and then they go out there and execute. Our case is exactly the opposite. We're a stabilized, long-term business, been around 20 years, top-line revenue over $100 million, and free cash flow of over about $52 million free cash flow. Currently, we have 107 facilities in 9 states, and our dividend yield, we've already raised the dividend twice, and we're just paid, I think, our 5th dividend, and our dividend yield is over 6%. Our FFO or our AFFO is about $52 million in 23. That's what we expect it to come in at, which is about $1 a share. We expect 2024 to be $1.07 a share. Most REITs are valued at a multiple of that AFFO. I think there's a normal range of between 10 and 15. Today, we're trading just below 8 times, which we feel is a real discount. Adjusted EBITDA in 23 is estimated to be $1.54, whereas 2024 forecasted to be about $1.80. Our net debt to EBITDA is below 6 times. Most people think that's great. Others think it's a little bit still high. We're working on cleaning that up. But our debt is really different than a lot of the other debts because we're sitting with long-term debt over 20-year. More than half of our debt, we're leveraged like 50%. And out of that leverage, half of that debt is in long-term debt with an average rate of 3.88, which is tremendous. Our timeline of how it began, like I said, we started in 2003, and we just kept accumulating facilities. And in 2015 is when we started the predecessor company, Strawberry Fields. And through that, we continued to grow. You can see this chart here and how the growth has been. Interesting to note, typically, is that we've been buying the same exact way. How we buy our assets, exactly the same way for all the years that we've been doing this. It's relatively boring in the sense of, we don't diverge from our strategy, and we don't diverge from our underwriting matrix and how we do everything. To us, this is a legacy business. We started from nothing, and we built it up with God's help, and hopefully we'll continue doing that. And none of us are compensated on growth, and none of us are compensated on how well we do. It's just keep doing business the way we've been doing business, and that's where we are. This is a map of our facilities. It's over 12,000 beds across 9 states. You can see that we're mainly in the Midwest. The way our business runs is we like to do master leases, so we're not just leasing one-offs to people, and it has to be in places where we already are, so we could grow master leases, or big enough of a portfolio that if we go to other states, that it should be manageable. The basic idea is, right, with the background of having been nursing home operators in the past, I look at each deal as how would I run it? What would I be doing? We want to make sure that the facilities that our operators that are inside our facilities are taking good care of the residents. And the premise beforehand, when we're deciding what to buy, we want to make sure that the pro formas and what they're expecting to do is appropriate and that they take good care of the residents. The operators that operate for us are including Infinities, which is kind of a related party. It's not exactly a related party, but I have ownership in it, so we call it a related party. But I have no responsibility towards managing them. But we have Landmark Homes, which are mainly they're mainly Kentucky operator. We have Oasis, which is mainly an Arkansas operator. We have Bria, which is mainly an Illinois operator, and then we have Creative Solutions, which is in Texas, and that basically rounds out our tenants.
And you're in Oklahoma, is that correct, Moishe? You're also in Oklahoma?
Yeah. We own a hospital and a nursing home in Midwest City.
Great.
And that's ran by Bobby Snyder, who's a really, really great CEO. He's been at that building probably 10 years before we bought it. Really, really good. And they're a stalwart in the community over there in Midwest City, Oklahoma. We love Oklahoma. The women are pretty and the people are nice. And it's a good place to be. We never really grew there because the footprint didn't present itself the right way. But if we could buy a big portfolio, we would.
All right, you're not wrong. We do have some questions from our viewers, and I know that's important to you. So let's hop into these questions. Sarah Davis asks, how have the interest rates affected the REIT space?
So unlike other REITs out there, I put on the screen here our debt structure, and you could tell that from our total debt, the bottom two are 11 plus year debt, straight line AM that originally started with 30 to 40 year loans, and the interest rate averages out with everything is 3.88. So we're not really affected by that. The only floating rate we have is we have a SOFR plus 350, 165 million, and everything else is fixed. So we're not really affected by that. We're fortunate enough that with being a true play skilled nursing facility REIT, for the most part, we have access to HUD debt, which for this kind of business, it's great because it makes our budget wise, it's the same exact payment for the next 35 years at a low interest rate.
And Carlos Travera wants you to talk a little bit about what your portfolio looks like.
So again, out of 107 assets, about 95 of them are skilled nursing facilities, and then there's 2 hospitals, and everything else is assisted living. Again, we've always been able to tell investors and bankers and otherwise that what makes us different from other REITs is that if, God forbid, something goes wrong in one of our assets, I could always step in and stabilize it myself. A lot of the other, if you were a multifamily REIT, something goes wrong in a building, they have to go and replace a management company, and there's nobody there that hands-on can go there and actually run that. They don't have the capacity for that. Our world's a lot different, and it should give a lot of comfort to investors to know that what we're playing for is stable, steady returns, and with limited risk, and mitigating those limited risks. And in which case, in our cases, the risks are regulatory and getting shut down, not financial performance and the like. And so we're proud to say that if not all, most of our facilities are rated well and are ran real well by our tenants.
Michael Gell wants you to speak to the attractiveness of HUD financing to your business.
Oh, Michael Gale has a great question. I love HUD. And I love this company called Newpoint. They replaced another company, which replaced another company that had been started by friends of mine. And, HUD is really attractive for this asset. And, it's really important to find the right shop to take good care of you, that's in tune with your needs, and knows your business well enough that they could deal with what has to be done. Michael, that's a good question, and it's very important to us that we continue that relationship in the HUD space. and having the right lender is important.
Lou Freeman asks, how are you acquiring your assets? Are you borrowing from your own assets, or are you subject to the issues of rising rates?
So again, our business is about 50% levered today. We have a lot of capacity with our banking relationships. We also have availability in corporate debt that corporate bonds that we floated in on the Tel Aviv Stock Exchange years ago. So as far as finding deals, I mean, I've been in this business 20 years. We get lots of deal flow, and we have a lot of relationships with a lot of different brokers and a lot of the operators. So when somebody has trouble, typically I know about it early enough. And our underwriting, like I said earlier, our underwriting is exactly the same way it's been for many, many years. So either the deal fits in our wheelhouse or it doesn't. And and like I said earlier, the interest rates really don't play a role in our world from the point of view of we have long-term financing lined up to be at a lower interest rate, and that's how we roll.
Okay, well, that's interesting. What about property values? John Garrett asks about property values and what they've done to your balance sheet over the past 12 months. And are you equipped if it falls? Will that hurt your leverage?
So let me tell you, our financial statements are under GAAP accounting at the lower cost of market. So we're showing everything at historic values. Our business, because we have long-term leases, all of our leases are 10-year leases with 2 5-year renewals at 3% annual increases. And because of that, the appraisals are not based on economic terms. They're based on their lease fee appraisals as opposed to, fee simple appraisals, which that basically means, if you were buying, let's say, a Walgreens, you have a 30-year income stream and you have to discount the income stream and you got to assign a cap rate. And so it basically keeps it stable. So up or down, a quarter point here and there has no real effect on our balance sheet. And, I can't stress it enough. Our business is kicking off a 6% dividend yield, which is only a 44% payout ratio. With that being said, because of that, the REITs, how they're valued, are a multiple off of cash flow. And again, ours is undervalued. And so really, interest rates changing or the valuations, I bet you we have embedded equity of valuation that's probably $300-500 million more than we have on our balance sheet today.
Great. Moishe, last question for you. Neil Ortega asks if you own properties that you do not operate.
Yeah, out of the portfolio of 107, 61 of them are leased to entities that I am a partner in. I am not a manager on any of them. There's a real Chinese wall. I have nothing to do with the operations, except if I am a partner of a partnership. So if someone were to ask me to help out with something, typically, before today, I when I was working in it, I was decent at the part of the business that I did, and so I'm a team player. If I'm ever asked, I'm glad to pitch in and do what I got to do.
Great. Well, thank you so much. We look forward to you continuing on with our conference, giving us more updates. This was wonderful today.
Thank you so much for having me.
All right. Well, we are complete with our conference. I want to thank everyone. What a day it's been. Know that in just a second, you'll be redirected to the registration page for our next conference in March. So reserve your spot early. On behalf of all of us at the Emerging Growth Conference, I want to thank all of our presenters and attendees for making this such a great success. Please follow us on YouTube, youtube.com/Emerging Growth Conference, and Twitter or X at Emerging Growth C. We always post new information on X first. I'm Anna Berry. On behalf of myself and our entire team, we wish you a really great rest of your day and a great rest of your month. We'll see you soon.